One of the major themes we've seen in the government, or in the corporate and government bond market this year, has been the significant inflows from the offshore investors. Now, we've seen this trend continue from last year and the year before, where in 2011 we saw inflows of about 60 billion rands into the bond market, and last year I think the number was about 49 billion rand. Year to date we're sitting at 75 billion rand, and that number still does seem to be climbing. One of the major reasons for this increase in buying in our bonds has been the inclusion of South Africa into the World Government Bond Index. This has played a significant role, and we were included last Friday into the index, but surprisingly the market had limited impact on the inclusion. So the buying actually during the course of this year and the previous 2 years has been reweighting in South African bonds in global indices. And also you've seen the emerging markets gain huge favor relative to some of the other emerging markets, developed markets out there. You know, we've seen the US and Europe, and all the talk is for lower rates for longer in an environment where inflation does seem to be at almost zero. And this has led to a lot of investors looking for the additional yield pickup. And obviously the emerging markets is the place to be on this. In fact, just recently, today I think it was, PIMCO put out a piece where they said they see continued inflows into emerging markets, and the countries that they really liked was Brazil, Mexico and South Africa. And you know, they saw continued inflows into these markets through the course of 2013, which obviously means continued support for our bonds, despite the fact that a lot of the local real money accounts tend to look at it from a historical value perspective. And if you do look at it from that, you can see why we sometimes tend to feel that our bonds are overvalued. If you look at the R186, one of the longer dated benchmark bonds, we've seen a rally of about 130 basis points in the last 12 months. And you look at the shorter dated R157, we've seen just under 180 basis points also in the last 12 months. Now, the main story over the last week or couple of weeks, and the biggest talking point, has been the South African government bonds being included into the World Government Bond Index. The anticipated inflows into South African government bonds was anticipated to be around about $8 billion worth, but now we've got to keep in mind that offshore investors have steadily increased their allocation into emerging markets and South Africa as such. And if you look at the offshore allocations and holdings of South African government bonds, these numbers have increased from the mid-20s to just over 32% year to date. So significant numbers that have come through. As mentioned, with the inclusion of South Africa into this government bond index on Friday, the price action wasn't as aggressive on the downside, i.e. rallying downside yields, as what was originally anticipated. And I think a lot of the street, the hedge funds, the banks, primary dealers, etc., had pre-positioned themselves for this rally in these bonds. So the offshore investors tend to look at South Africa as a relative value play, relative to, as I mentioned, to Brazil, Mexico, Turkey, Hungary and the other emerging markets. And when you look at the other emerging markets relative to the developed markets, there's still very good yield pickup to be had by the emerging markets and by South Africa in particular. So I don't think you're going to suddenly see a wave of exit coming through from these investors in the near future. You know, the lower rates for longer coming out of the US, we've seen what's happened in Europe. Do you want to be holders of Spanish and Italian bonds at the moment, or would you rather go for the South African bonds, which quite perversely almost do offer you almost a safer investment than a lot of those other countries? The local asset managers do, however, look at the bonds from an internal and a more micro perspective, where they look at what is actually happening in the current account deficit, what is happening with our funding, and they look at it from a more historical perspective, as well as looking at us relative to the global emerging markets as a whole.